Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Chart before, if you've been on some of these webinars in the ISE, I've shown this, and I think it's important really just to gain some perspective. The currency market as we know it started back here, and let me use a pencil, that was a little too thick. When we went off the gold standard back in 1971, President Nixon took us off the gold standard, and the currency markets as we know it now started then. And this just showed, this black line is the U.S. dollar index, and I'm showing just the major bull and bear market cycles, as you can see in the U.S. dollar. I've also marked on this chart some of the major events, of course, that launched these bull and bear markets. Again, going back with the gift of hindsight and marking these on the chart. We're all very smart with the gift of hindsight, but I think some of these things apply. Obviously, when we went off the gold standard, dollar fell. Then Volcker came in as Fed chairman and squeezed inflation, hiked up interest rates in the U.S., and the dollar went in a huge rally against the other major currencies. Then we went into a bear market cycle. Next bull market cycle was driven by the tech boom. Tech bubble burst here in 2000, and sure enough, we've been down, down, down. What we think could be a game changer here, and also plays into this idea of whether or not the reserve currency status is going to be held in a very, very big way, is the credit crunch. It's an important change and really a sea change in the global economy. A lot of people, again, are seeing the credit crunch and viewing it as, hey, the dollar will lose its reserve currency status because of the credit crunch. We, Black Swan, tend to actually argue the other way, that the credit crunch is a game changer that may lead to a strength in the dollar and actually some shoring up of the U.S. financial position globally, and I'll get to that. So just be careful with this idea that because supposedly that the U.S. was the driver of all ills in the global economy because of the derivatives and the derivative problem, therefore the dollar, by virtue, has to fall. It doesn't. And in fact, there's some things going on in the background which we think, as I said, are really game changers and really could actually make this idea of the reserve currency status really just go away out of the mind of the market, within the next several months, but we'll see. So the question is, dollar was launched in a pretty strong bull market move after the credit crunch. We're now in correcting time, and I'll show you where we are on this. Are we in a new bull phase in the U.S. dollar? Are we in a new bear market? And this is where, again, this idea of the reserve currency status is coming into play. People are afraid that that is in the market, and that is the play long term. And if that's the case, the dollar falls off the table. I can tell you one thing, that if you're a U.S. investor and most of your assets are denominated in the U.S. and tied to the U.S. economy, you don't want the U.S. dollar to lose its reserve currency status in terms of it falling off the table, because think of it this way. Your purchasing power is in dollars, and if the dollar falls off the table, you lose purchasing power. No doubt we all would try and shield ourselves by moving money offshore, but the reality is U.S. consumers would be a lot poorer if this were to happen, because this transition to a new currency order would take time, and it would be a major dislocation for the global economy. And the fact that the U.S. consumer is still the major driver of demand in the global economy, if his purchasing power declines tremendously, it's going to hurt everybody, not just the U.S. So it's one of those, I see a lot of people out there that are chanting or looking for something like this to happen, and they're turning around and buying gold, but I think it's one of those we have to be careful what we wish for here. This is a shorter term chart going back to really where the last bear market in the U.S. dollar started back in 2001, and I think this is important to understand what happened here so we can define some of these terms as they exist right now. The dollar came down for about 7 years in a bear market, and I'm going to call this a 7-year bear market. It may be a lot longer, obviously, if this comes down through. We're going into 8 or 9 years, and this is just a correction in a long-term bear market, which absolutely may be. None of us know that at the moment. But I'm referring to this as the bear market in the dollar period here, the last major bear market, and also terming it implicit weak dollar policy. And I'll show you on the next chart what I mean more by that. But the reality is, when the U.S. dollar goes down in this bear market like this, it means the supply of dollars was really being spread out around the globe. And as I said earlier, that volume penetration, that supply of dollars around the globe during this bear market move right here is a factor in actually boosting the dollar as a reserve currency status in terms of percentages out there. So we saw that, and then we saw the credit crunch come in. The dollar had a major risk bid in here, and then we've had this green shoots era, which, you know, China is growing, the emerging markets are growing in a very, very big way. Stock markets are taking off, and people are selling the dollar again. Selling the dollar basically just means moving some money offshore to the capital gains opportunity in Asia and some of the emerging markets. So the question is, will this continue? And if it does, and this idea that the emerging markets are really going to be the drivers of growth in the world, will we have a new reserve currency status? Will we have a basket currency? Will we start to see more of the deals on the edges, like China using its currency, trying to replace the dollar in some of its cross-border trade deals with individual countries? We could actually see that, and we could see two scenarios really play out. We could see the dollar start to lose some reserve currency status around the edges, and the dollar still not necessarily fall off the table. If you think about it, currencies out there that aren't world reserve currencies do quite well and run in bull and bear market cycles. Or we could see this idea that I see one of the that Mary had put up, that the view that there's going to be a real collapse in the U.S. economy, some type of permanent collapse in the U.S. economy, and therefore the dollar would fall off the cliff, and countries out there holding U.S. debt would clamor for a new currency regime globally. And really, that's really the driver here, I think, is this idea of debt and the amount of debt that the U.S. is throwing in the system in terms of its system and actually spreading out around the globe. This idea of just weakening the U.S. financial position, which they've done over the years, but now they're accelerating in a very, very big way in order to be the stimulator of last resort, I think really is the key here and has everybody concerned, and no doubt it should be a concern. These are some comments from John Taylor, who was the former Undersecretary of the Treasury under Bush, pretty smart guy, professor at Stanford, came up with the Taylor Rule of Monetary Policy. He wrote a piece in the Financial Times a while back, you know, talking about all the systematic risk that's being created by the Fed because they're basically using the Treasury or monetizing the Treasury debt by the Fed buying the Treasury paper. It's monetizing the debt, which is a very, very bad thing in economic parlance, needless to say. And he talks about the idea of the federal debt, which was equivalent to about 41% of GDP in 2008, and these statistics are pretty amazing, increasing to 82% of GDP in the next 10 years. Now, again, given the level of debt being thrown into the system, those numbers really aren't off the table at all, and maybe actually a little bit conservative if things don't change. In his idea that, you know, we could see 100% of debt to GDP in the next 5 years, and if we see this AAA status of the U.S. Treasury start to be removed, that's again a hit at kind of the major prop here. The world reserve currency, again, tends to be supported in times of trouble because of the fact of the depths and its safety issue. If this idea that the U.S. Treasuries, which have always been considered the safest investment in the world, if people start to look at those in a different way, that really does eat away at the U.S. reserve currency status. They'll start to look to other capital markets, and you can bet some of the other countries would get busy trying to deepen their capital markets as an alternative to the U.S. Treasury market if we see this credit rating fall.